Hello, friends. Wonderful greetings of the day to all of you. I hope you all are prospering in respective domains of your lives. So, here I, Kunal Nagpal, once again welcome you to this amazing economic session. Dear friends, today we are basically going to discuss the fiscal and monetary policies and how center is sure of meeting the fiscal deficit target in this particular financial year. And we are also going to discuss that how the industry bodies are urging the Reserve Bank of India to moderate the pace of the monetary tightening. So here it goes. Center is basically sure of meeting the fiscal deficit target. The center expects to meet or even do better than the budgeted financial year 2023 fiscal deficit target pegged at 6.4% of GDP on the back of buoyant revenues, officials said. Several ministries may not be able to utilize their full allocation for the year, providing a cushion to the finance ministry in order to meet the sharply higher requirement for food, fertilizer, and petroleum subsidies. The higher than budgeted nominal gross domestic product, that is the GDP growth, will also help the fiscal deficit numbers. We are confident that we will meet the fiscal deficit target. It could even be better in the percentage terms, a top government official told Economic Times. The government expects its gross tax revenues to basically exceed the 27.6 lakh crore rupees financial year 2023 budget estimates by at least 3 to 3.5 lakh crore rupees. Revenues have remained buoyant with both direct taxes and the goods and service tax, that is the GST, posting strong growth. This is amazingly good news. The central excise collections have basically been muted, having borne the brunt of the tax cuts to cool down inflation, the official said. The windfall tax levied on the domestic crude is also unlikely to yield much, as the government is also losing commensurate revenues on the profit petroleum. Divestment is also expected to be less than the 65,000 crore rupees estimated for the financial year 2023, with privatization of the public sector banks likely to be taken up this financial year. The single nodal account for the management of the central sector scheme, that is the CSS funds, a significant expenditure reform has also reset the release of funds for the welfare and development schemes. The funds are released directly to the states based on utilization, which has streamlined the process, but spending has been slow as the new system settled down. States have also substantial unspent amounts. As a result, many ministries may not be able to utilize the financial year 2023 budgets fully, providing room for the finance ministry to meet the demands elsewhere without derailing the fiscal deficit. The total expenditure budget for the financial year 2023 is 39.4 lakh crore rupees. In the first half, the government spent nearly 18.2 lakh crore rupees, that is 46.2% of the full fiscal estimate. In contrast, the center collected 52.7% of the budgeted receipts in the first half of the fiscal. The budget projected the nominal GDP growth for the financial year 2023 at 11.1%. The actual growth may be much higher given the high inflation. The nominal GDP growth in the first quarter of the fiscal year was 26.7%. So what is the main summary of this entire article? On course, government is quite confident of meeting the financial year 2023 fiscal deficit target or improve it. The buoyant revenues, higher nominal GDP growth to aid. Both goods and service tax and the direct taxes have remained robust. Next, the center could also have savings on the expenditure front. And lastly, the increased fertilizer, food, and petroleum subsidies are a challenge. So the financial year 2023 fiscal deficit target pegged at 6.4% of GDP. Now, going forward, guys, we would basically discuss how the industry body of India urges the Reserve Bank of India, that is the RBI, to moderate the pace of monetary tightening. The Confederation of Indian Industry, that is CII, recently asked the Reserve Bank of India to consider moderating the pace of its monetary tightening ahead of the forthcoming monetary policy review, citing challenges emanating from the global headwinds. Given the headwinds to the domestic growth mainly emanating from the global uncertainties, the RBI should consider moderating the pace of its monetary tightening from the earlier 50 basis points, the industry body said in a statement. The Monetary Policy Committee, that is the MPC, will meet December 5 to 7. According to the CII, that is the Confederation of Indian Industry, the domestic demand is basically recovering well, as mirrored by the performance of a as mirrored by the performance of the host of high frequency indicators. However, the prevailing global polycrisis is likely to impinge on India's growth prospects too. So this is the challenge for us. While the CII is cognizant that RBI's interest rate hikes of 190 basis points so far in this fiscal have been warranted to tame inflationary pressures, the corporate sector has now started to feel its adverse impact, it said. So, dear friends, as we have seen the basic modifications done in the basic modifications suggested in the fiscal and monetary policies, and this is actually of vital importance for the overall sustenance of our economy considering the global headwinds going on in the current scenario. So on this note, I would like to end today's session. I hope it was really vital for you as well to understand the core intricacies of today's news matter. And I really would be delighted if you could share your valuable feedback and suggestions in the comment section of our session. Thank you so much. Namaskar. Jai Hind.